What's up everyone, it's Caddy with MoneyVest. So we've got lots to unpack in this market update. I am back in India, so I'm visiting my family here. My nephew is coming in this weekend. He's going to be 3 months old and I'm super excited to see him again. So I'll be going back to Dubai in about a couple weeks here, but just wanted to, of course, give you guys an update on the entire process of course, the markets here, because there's been a lot of updates on S&P 500 targets for the end of 2024. Ed Yardeni putting a new target on the Dow Jones by 2030. And then we also have some concerning catalysts and reports related to delinquency rates on credit cards in the US as well. A couple more updates. By June 15th is when we are expecting the beta launch for the MoneyVest platform. And the only phases that are going to be available is phase 1 and 3 at the moment, and phase 3 being the most important phase of all for our software includes the entire fundamental analysis, including our MoneyVest metrics, our financial calculators and models, as well as a lot of other really interesting data points and charts and graphs that you can use as a user to analyze stocks across the board in the US for all publicly listed companies. So we're super excited for that beta launch. I'll be sharing more details as the date gets closer and closer. But again, thank you so much for joining our community. Link's gonna be down below if you wanna access all the members only private videos, including 50 plus tutorials. There's a 16% annual discount available until the end of May. And of course, you get access to all the Discord channels, including trade alerts and trade ideas, options alerts, and everything else as well. And we also do have a sale going on for all of our individual courses, 50% off. And this sale expires at the end of this month as well. And again, the coupon code is going to be May50, expires on May 31st. So link's going to be down below. So first things first, Ed Yardeni essentially talking about the Dow Jones getting up to as much as 60,000 by the year 2030. And that is essentially going to be an increase of about 7%, give or take. And that's pretty average, right? The Dow just hit a new all-time high at almost 40,000 for the first time ever. And 60,000 is going to be a 50% increase over a 6 to 7 year period. And if you look at a compounded annual rate on a yearly basis, that's going to be about a 7% to be precise by 2030, which is about average. So there's nothing super crazy about this call. It's not like they're expecting S&P to more than double by 2030 or go to 100,000, but 60,000 is a very average target, and that's been the average return on a year-over-year basis from the Dow Jones. Now, moving forward, one of the biggest bears on Wall Street, Mike Wilson, has finally capitulated and has turned into a bull in the markets here, because as we know that over the last year and a half, 12 to 18 months, Mike Wilson has been one of the biggest bears on Wall Street, calling for market sell-offs, calling for market crashes, calling for a drop in equities and stocks and whatnot. There's been a lot of theses from Morgan Stanley's Mike Wilson, which almost every single one of them have been wrong. And that's exactly why I've mentioned this before time and time again, that making predictions in the market is a loser's game. It is absolutely useless and a waste of time to try to predict what's going to happen. And that's what sells, right? That's what sells in the media. That's what sells everywhere on articles and headlines. If somebody's predicting something, that's what we as humans are very much gravitated towards, because we feel like, okay, that's a prediction and I can make bets or I can make decisions off of those predictions. But most often than not, those predictions are incorrect or don't turn out to be true. So as I mentioned before in my previous videos, and I will continue to kind of hammer on this point, instead of trying to predict what the future holds, try to analyze the current, more present situation and what decision is best for you, whether it's buy, sell, hold, do nothing, hedge, sell calls, buy puts, whatever the case might be. It's more important to try to assess your current present financial situation and the current present market environment and try to understand the risk and the reward in the current market. And that's what Howard Marks teaches us. That's why you will never hear Warren Buffett make a prediction or talk about where he thinks interest rates are going to be a year from now. That's why you never hear Peter Lynch talk about where the markets are going to be a year from now, because these guys who are legendary investors who've been doing this for decades know that they also don't know where the markets are going to go. They trade and invest based on what they can see and understand about the markets today in the present moment. And again, we've talked about this over and over again, but this is what media, this is what everybody likes to hear and listen to, is predictions. What is your prediction about the market, right? Which again, as I've been very clear, I can be very honest with you and I can tell you, like, I don't know. I don't know where the markets are going to be 12 months from now. I don't know where interest rates are going to be 18 months from now. But I'm investing based on what I know today about the markets and the risk reward present in the current market environment. Now this right here, speaking of predictions, these are S&P 500's price targets by a lot of other Wall Street firms and banks, and almost every single firm has raised their price target on the S&P 500 for 2024 as the markets continue to move higher to new all-time highs, again hitting highs of over 5,400, and the average target is 5,289 with the median target of 5,400, which has been increased by 5,200 and 5,117 for average number here respectively. This was as of March 25th. So just in about a couple months here, we've seen a reasonable increase in price targets on S&P 500. BMO Capital Markets here increasing from 51 to 5,600, so 500-point increase. Wells Fargo increasing from 4,625 to 5,500. It's a 900-point increase here from Wells Fargo, and Deutsche Bank by 400 points, Oppenheimer by basically flat, so no change there. Societe Generale also very, very flat. Morgan Stanley also increasing by 900 points. Mike Wilson, thanks to him. Bank of America, flat. Ed Yardeni, 5,400, also very flat. RBC, 5,300, so about 150-point increase. Barclays, flat. Goldman Sachs, flat. UBS Wealth Management, flat, no change. Fundstrat, also flat. Citi, also flat, and JP Morgan also not changing their target. So there's been just a few firms and those who have increased it to the upside, of course, and S&P 500, the median target now expected to 5,400, which is actually not that far off from where we are at the moment. So if you come over to the S&P 500 at 5,300, that's only 100 points higher than where the S&P is trading today. So that's going to be about an upside of about under 2% for the rest of the year. So under 2% rest of the year, that's not a lot of upside, but there will be more upside if the markets do retreat first and then close the year at 5,400, which is exactly, the game plan, right? So for us to wait for a better risk reward, for us to wait for better market prices is exactly where the patience comes into play. And today, S&P 500 achieved its 24th all-time high for 2024. So this was from Seth Golden. Shout out to him putting this table together. And only one other time in history did the S&P 500 stop making more highs for a calendar year at number 24. That was 1980, a 98% probability. So right now there's a 98% probability the market makes at least 3 more new highs in 2024. Also, only one time since 1980 was the top in May. So 1980 was the only year the S&P 500 did not make any more new all-time highs, and only one time since 1980 was the top in May. So May was the top, and of course at the end the markets were lower in 1980, but every single time we've seen new all-time highs in the market. And looking at this table, essentially suggesting that 3 more new all-time highs expected with a 98% probability in 2024, which again is very, very strong. And as we've talked about before, markets, the bull markets are, and of course the growth in the markets is much longer lasting, much more powerful than as opposed to bear markets and recessions and economic contractions and of course sell-offs. Sell-offs are more brutal, more painful. Of course, the pain that we get from stocks selling off is far greater than the pleasure that we get from markets moving higher, but it's also shorter, but the bull markets are longer lasting. So always obviously keep that in mind. And this right here is the S&P 500 pullbacks of over 5%. And since 2009 and subsequent rebounds. So markets, of course, have pulled back over 5%, this year, and the subsequent rebounds on average have been about 19.5%, right? 19.5% for the markets, and median 17.4%. So considering these numbers, if we take kind of like a combination of those two, about 8%, and this right here was the pullback of over 6% for the S&P 500. So 18% from that 4950 level puts us actually closer to 6,000, I believe, if I'm not mistaken. So that's going to be closer to 5,900, right? If that math checks out, because historically since 2009, every time the S&P 500 pulls back over 5%, the subsequent rebound on average has been 19.5%, median 17.5%. So about 18% is going to put us roughly at 5,900, and the median target on Wall Street is at 5,400. So just giving you a little bit of an idea. Of course, this bull market has been very strong, very powerful, lots of momentum, lots of liquidity flooding into the market as earnings continue to hold up really well. There's growth year over year. And again, a lot of other economic metrics. Inflation's been cooling down, economic growth has been very resilient, unemployment rate continues to stay low. So there's a lot of reasons why the markets are moving higher the way they are. Now this right here was a little bit of a technical bearish post from Kurt. Again, shout out to him, basically essentially talking about the negative divergence between the S&P 500 hitting the all-time highs, and again, the RSI continues to be overbought and then trending lower, making lower highs, and that has preceded corrective volatility in markets seen in 2007, 2018, 2020, and 2022, and something that we are witnessing once again, as he points out, that the markets continue to move higher here in this all-time high fashion, where the RSI continues to come down in this lower highs, basically continues to remain overbought and also making lower highs, as we have already witnessed several times in the past, suggesting for a pullback or a correction or also a bear market in the S&P. So look, the idea is the markets are on this very nice uptrend. We're hitting new all-time highs. That's fantastic. Everybody's having a good time. This is a very pleasurable moment for everybody who's long and invested in the markets, right? So I'm sitting on about 16 to 18% cash. And I'll be mostly deploying that when the markets, cool off a little bit, when I find better opportunities. But mostly 75 to 80%, over 80% still invested long, so able to take advantage of this rally here. We'll most likely start selling calls. But the idea is that just because we're moving higher doesn't mean we're going to continue on this path forever, right? As objective as I can be, as cautious as I can be, we have to still be alert, especially when you consider market volatility is coming down to really, really low levels, right? So this right here, as we've already talked about, VIX is low at 12.4, so 12.77 percentile, extremely rare to see the VIX this low. So any day now or any time we can see the volatility spike and the markets see that corrective sort of dip opportunity here, right? The markets can pull back, and that's where the actual opportunity will be, and we can start dollar cost averaging once again, because the last buy signal, the real buy signal that we got, deployed about 10 grand worth of stock into stocks here, was back on April 20th. So 420 was the last time when we actually got a pretty decent buying opportunity, and since then we've just been able to take advantage of the market rally here. And the next time the markets roll over, the next time we see that risk reward getting better, again, you bet we're going to be sending out alerts. We'll be talking about, dollar cost averaging, being more aggressive in the markets once again. So it's just really trying to finding the best risk reward in the markets, and it only gets better as prices come down. So always remember that on the channel, as I've always conveyed this message, is that as prices come down, risk comes down. As prices go up, risk goes up. A lot of people correlate prices going up with a high potential reward, and that's okay because momentum's in your favor, and as prices keep going up, your returns are going higher. But always remember, the risk is also going up at the same time, right? So you're taking on more and more risk for marginally less and less return. So this right here is going to be a whole sector overview that I wanted to go over. So primarily communication services and technology are the two leading sectors in 2024 by 19 and 15% respectively. Then we've got financial and utilities coming in at a reasonable second and third, or actually third and fourth, 11 and 10% respectively. Energy, industrial, consumer defensives, healthcare, they're all up anywhere between 7 and 9%. Then we got consumer cyclicals only up 3% thanks to Tesla, which is not doing anything. Basic materials up 5.7%, and real estate is the only sector that is down on a year-to-date basis, down about 4%. So this is the entire market, a lot of liquidity flooding out of other sectors over to semiconductors and technology and communication services. And this right here, again, is going to be the entire market. So again, you can see what sectors were red, where the money is going to. And this right here is in the last 1 month. And again, a lot of sectors are green, but more so NVIDIA, Apple, Google, Microsoft, Amazon, TSMC, Broadcom, AMD, even Tesla's up 19%. Costco's up 11%. Eli Lilly's up 7.5%, almost 8%. So a lot of these stocks here pushing up, really doing well, especially the semiconductor sector. Once again, pushing up to new highs. And a lot of cybersecurity companies, including Palo Alto Network, Oracle, Adobe, also SaaS companies doing incredibly well here. So it's really been technology's world, and we are all living in it, including all the other sectors as well. In the last 1 month though, all sectors are green. All 11 S&P 500 sectors are up. Volatility pushing higher a little bit. Everything else, including corn, soybean, platinum, silver, gold, pushing down. And we got Bitcoin back over $70,000 and Ether just over 3,600 as well. Now this right here is something that is a little bit of a concern that I also wanted to break down, and that is essentially credit card delinquencies, and essentially talking about creditors or essentially borrowers who are maxed out on their credit card balances. So what this chart essentially shows us that 18% cardholders who are maxed out on their credit card are now seeing a high level of delinquency rate, right? So they're very, very high in their utilization rate, and they're essentially maxed out, and they're seeing more of a higher delinquency rates than compared to cardholders that are not maxed out, right? Pretty obvious. And that's, that to me is a little bit more concerning because it's going to have a rippling effect over to other parts of the market as well. So 18% cardholders who are maxed out transitioned into delinquency at a much higher rate than before the pandemic. And this right here is going to be the overall credit availability, which is rising. Of course, banks want to make their money, so they're making more and more credit available to borrowers, and $4.85 trillion was available in credit card limits. That's absolutely nuts that almost $5 trillion is available to cardholders as of first quarter 2024 to spend on credit card debt. And the interest rate, of course, is going to be over 25%. So just imagine 25% on almost $5 trillion is crazy. It's absolutely crazy. And of course, the credit card balances were 1.11 trillion. So there's still an unused credit limit of $3.74 trillion as of first quarter 2024. Now, other consumer credit balances, personal loans, payday loans, and buy now, pay later loans that were 30 days or more past due inched up to 7.6%, a tad above where it was in 2018 and 2019. But credit card delinquencies, of course, 30 plus delinquencies now getting up to almost 9% here, which again, it is quite concerning here. 30 plus days delinquent balances for credit cards getting up to over 9%, which of course is definitely something to keep in mind and be cautious about. Now, coming over to the markets, volatility up 2.6%, as we have already discussed, really, really low levels. So starting to see a little bit of that momentum back higher. So it's got to be careful with where the markets go from here, considering that VIX is at really low levels, extremely rare levels. And if you do see the VIX higher, that's obviously with a negative correlation, it's going to put the markets a little bit lower, back on that dip / correction territory with a resistance up to 15.33, really just a target, not really a resistance, up to as much as 18 and 20. Very, very attractive levels for the VIX over there as well. Talking a little bit about Bitcoin and Ether with a massive increase of 19%, getting up to as much as 3,700, and Bitcoin also to over 71,000, back up to almost new all-time highs. This right here was a support level that we talked about on the channel, and we're seeing a very, very nice increase of about 19-20%, and of course getting up to that resistance, that area of supply for Bitcoin, pretty much back at all-time highs here. So huge congrats to all crypto bros and crypto holders for, of course, a massive increase in prices for Bitcoin and for Ether as well. Coming over to the S&P 500, and more specifically the MoneyVest index at 3.95, so still kind of flirting in and around that higher levels. So it is red, and it is closer to that 4 threshold that we track very closely. So really just waiting patiently for prices to cool off. Better risk reward opportunities is going to lead to better buying opportunities and better tradable opportunities on the long side. So it's really just it's a game where I'm personally just holding what I have, selling calls against my shares, and having dry powder ready for the next opportunity. Because like I said, 420 was a last serious buying opportunity. The next time you actually get down to that level, we're just going to rinse and repeat the whole process and start buying up stock and start trading on the long side again. But right now, it's just the time to sit back, hold, sell calls, and sometimes just do nothing, right? Really, right? So just take advantage of the rallies that we're seeing and new all-time highs that we're hitting on an everyday basis from the markets. Crude oil prices a little bit under $79 a barrel, so continue to consolidate sideways, and we're seeing a little bit of a pullback, and resistance going to be closer to $81, $82 a barrel, as we have already discussed. A little bit of a breakdown from this head and shoulders pattern, and next support really is going to be down at $73, $74 per barrel for crude oil. So a lot of consolidation sideways, and that is going to be that next target and that support that's only going to be helping inflation moving forward as well. So I'm going to give you a very quick update on S&P and NASDAQ, and we're going to be going over individual stocks, Magnificent 7 plus other stocks in a more separate, more detailed video, so that you can use that analysis, you can use that research to kind of help with your own trading plan and of course decision making for the week. So that's going to be on a more separate video. But going over to the S&P 500, pretty much all-time highs. Just be mindful that we are again overbought here, close to overbought on the RSI and the MACD. So RSI is 68, MACD's also been pushing higher. Like I said, this was the last buying opportunity, and since then we have pushed up 7%. Same thing with the NASDAQ. You can see that we're hitting new all-time highs at over 16,800. RSI approaching almost 68. MACD's also moving higher. Last buying opportunity was back on 420, so again April 20, and then since then we're up a little bit over 10%. I did pick up a lot of VUG at that price point, so that's up a little bit over 9.8, almost 10%. So just got to be super careful with where we are. Not saying that we have to sell our stocks and liquidate everything and run for the exits. Nope, that's not what I'm saying ever. I'm mostly invested long, but it's just the idea of remaining cautious and alert. And I will tell you, every time the markets are coming down, I will make videos. Get your cash ready. Be ready. These are buying opportunities. This is your buying window. This is where the risk reward is very good. I will say those words. I will put them on the title, and I'll be very clear and very direct that don't let this buying opportunity slip away, because the buying windows are short. Selling windows are much longer as you can start to kind of de-risk as the markets continue to rip higher. So that's all I'm going to say. Just be cautious, be alert. Markets at an all-time high. Congratulations. And I'll be doing a more detailed technical analysis on all the individual stocks, Magnificent 7 plus others, in a more separate, more dedicated video as well. So as always, make sure that you drop a like. Let me know your thoughts down in the comment section below. What do you think about this data point for credit card delinquencies? S&P 500 targets getting upped by 200-300 points on average. So let me know your thoughts down in the comment section below. And also don't forget to join our Patreon and Discord. 16% annual discount available until the end of this month, including all the members only private videos, all the trade alerts, and the beta access, early access to all the MoneyVest platform features and tools. And also do check out individual courses. 50% off, coupon code May50 also expires at the end of this month. As always, happy investing, and I'll see you all in the next video.